Welcome to the big show. It's the Retire Young radio show. If you're a first-time listener, thanks for stopping by. I am your host, Joshua David, and we are happy to have you with us today. On the show once again, I have my great friend, my great pal. I'm a little upset at him. He called me old today. How you doing today, Al?
Yeah, and I shouldn't be calling anyone old.
It's always
I'm doing well, by the way. Thank you.
Good, that's good. It's always great to be back, helping our Retire Young family make those better investing decisions. Al, we have another packed show. We had another phenomenal week in these financial markets. We had, obviously, there's earnings going on, so that's bringing some more volatility in the market, which is more action, more buyers and sellers. But we're also going to get into, these other markets. We have the stock market, and everybody understands what the stock market is. We're going to get into that, talk more about that and dissect it, but we're also going to dissect these other markets that are out there. The futures market, the Forex market, options market. Now, one of the things that we do on the Retire Young radio show is we dissect retirement and retirement accounts as well. So as we get into that today, we're going to talk about different concepts us as average investors can utilize, just like the institutions do. So Al, like I said, we had another phenomenal week in these markets, more volatility because of earnings. What's going on, and how can us as investors participate just like the pros do?
Well, first of all, speaking of volatility, there's no way that we can't have volatility in a market like this. As you mentioned, we're in earnings right now, earnings season. But then you add to that the coronavirus issue, the economy and the impact of the economy, the social unrest. We've got a presidential election coming up. These are all individually, enough to cause volatility. But when you combine them, there's going to be volatility for some time yet. And you mentioned the word opportunities. Yeah, there's a lot of great opportunities when we see these big moves up and down, but you have to be educated. You have to know how to take advantage of them and how to use different assets at different times to take advantage of different opportunities. But I think, when we talk to our students, you can't really control these things that are impacting the market every day, like the tweets and comments from different people. So what we really want to concentrate on is something that's reliable, something that is repetitive, that we can count on to give us great opportunities. But I think we start with this. Start by talking about or addressing and mitigating the two biggest mistakes that novice traders or the public makes. And one is buying high, hoping that prices keep going up, or buying low or selling low, hoping that prices keep going lower. It actually is the opposite of what people should do. It has you buying high and selling low. And when you look at where the market is right now, it's very highly valued. So you have to look at this as a more often than not situation where somebody is buying high and not taking advantage of these pullbacks to a point where, again, getting back to what's reliable, where we know what is going to impact the price of something when it pulls back into a certain range.
So, a lot of our listeners are probably thinking right now, well, the market's great. Why wouldn't you want to go in? So how does the average investor, get in at, we'll say wholesale prices
Sure.
and not those retail prices?
Well, the important thing, and number one, is to understand how the markets work. And what's really important as far as how they work is what drives prices higher or lower, because that's really the key. Again, if you want to buy low and sell high, you need to know where the low price is and where the high price is. And really what that does, if you can identify those two areas, you can identify a low-risk entry point, and then you can identify a profit target that is based on something that's realistic and reliable. And that all gets down to the relationship between supply and demand. We talk about that every week on this show. And there's supply and demand in the markets. We're just talking about buyers and sellers. When we talk about demand, that's where there is an excessive number of buyers or buyers with a high enough clout, financial clout, to have a position maybe with millions of shares of something to buy. And then on the supply side, that's where there are sellers in large numbers that will move the market the opposite direction. What we really want to look for here and to have the opportunity to really participate in the best way is to identify where unfilled orders are. And I'm sure people are going, what do you mean? If they're unfilled, how can we see them? Well, that's where the strategy that we use comes in. It identifies the imbalance in that relationship between supply and demand. And the reason that we can do this and that it works is that It's developed by people who actually put those unfilled orders into the market, making them then filled orders. And they did that at such high volume. They worked on Wall Street. These were the guys that worked on the Chicago Mercantile Exchange or Chicago Board of Options. And they were putting orders into and taking them out of the market in such high volume. It moved the market. It moved prices. And then they could see on a chart where these filled orders were and where unfilled orders were. And that's really where what we teach. That's what we talk about in these classes. I'm sure you're going to be talking about here in a few minutes. The key really is to notice or identify where the big buyers and the big sellers are, and then just follow them. So think about it for a minute, Josh. If you knew where there was a large amount of unfilled buy orders, where they were actually going to come into the market, couldn't you preset a trade, be all set to take advantage of that when the big players placed an order, when those orders became filled orders?
You can, and the nice thing about that is that's how the trading and investing works. Is investors can set their trades prior to things happening.
Exactly.
Like finding those areas where the institutions are getting in and getting out. But the computerized programs that we have these days are very sophisticated. We don't have to call a broker or somebody to make these trades, so you can place your orders ahead of time. It's just where you want to get in, which we'll call it a buy, and where you want to get out, which would be a sell, to collect profit. And that is how these financial markets work. And you mentioned one thing a little bit ago. You said you can't control what happens in the markets. What we can control is how we react.
That's exactly right.
Or how we don't react. And it's all about having a plan. And we're going to talk about having a plan in the next couple segments here. But we're going to get into some investing classes that I want to give away some tickets to, where we talk a lot about how the stock market works, how the institutions or the successful are utilizing the stock market to benefit from that. So, Al, we have a lot to discuss here today. In the next segment here, I want to talk about how the institutions or the successful traders are utilizing the market, like the stock market, to create income. They're also utilizing other markets as well, which allow investors to utilize leverage, but also trade any time of day. Don't forget to subscribe to the Retire Young podcast on Apple Podcasts, iHeartRadio, and Spotify. This is Josh and Al with the Retire Young radio show. We'll be right back.